Hello, and welcome to our fourth quarter market review and economic outlook for 2024. I'm Sean Tesoro, president of Salem 5 Wealth Management and Trust. Let's talk about what we've learned from the economy this year and what it means for your portfolio in 2024. The U.S. economy continued its stronger than expected growth in the third quarter, with GDP coming in at 5.2%. This, combined with the decline in headline inflation, led to a strong market recovery in November, with the S&P having its best month in 3 years, gaining 8.9%. But maybe more importantly, the U.S. bond market had its best month in 40 years, with the U.S. aggregate finishing up 4.9%. This has set the market up for a strong finish to the year and increased the expectation that the Fed can achieve the soft landing for the economy. Even with this momentum, our expectation is that the U.S. economy will continue to grow at a slower pace in 2024 as higher interest rates work their way through the economy. In particular for the consumer, non-mortgage interest payments are up more than 50% year over year. That increased debt, combined with slower wage growth, translates into a consensus view of GDP growth at 1.8%, which is a much more sluggish economy than what we experienced this year. And while it appears that the risk of a recession has been reduced, it's still a possibility next year, as a slower-moving economy will be increasingly sensitive to shocks, and the headlines are a constant reminder that there remain risks on the horizon that could push a slow-moving economy into a recession within the next year. So what does this mean for your portfolio in 2024? First, year-end is a good time to consider rebalancing, especially given the recent run-up in stocks. In terms of allocation, we would consider an overweight to intermediate-term bonds. If there's a silver lining to the higher interest rate environment, it's that bonds will be a more attractive place to invest not only next year, but the next few years. In fact, since 1984, core bonds have generated positive returns in every tightening cycle for the 6-month, 1-year, and 3-year horizons after the Fed stopped raising rates. As the saying goes, history doesn't repeat itself, but it often rhymes. So if history at least rhymes during this cycle, we'd expect intermediate core bonds to outperform cash and other short-term fixed income strategies. So what are the lessons we learned from this year as we head into 2024? First, work with your advisor to discuss or develop your long-term plan. Picking investments without knowing the long-term plan is like driving across country with no GPS. Second, you can't time the market. The last several weeks are a perfect reminder that you need to stay invested. Plenty of investors missed the recovery in November because they abandoned their plan during the banking crisis in March or during the market correction in September. And finally, stay diversified. For the last 70 years, a diversified portfolio of 60% stocks and 40% bonds have provided investors a positive return 80% of the time. From all of us at Salem 5 Wealth Management and Trust, we wish you a happy holiday season and a prosperous new year.